There is this very misunderstood concept called a credit score that has such a profound impact on our financial situation in our lives. It affects what we pay in interest on our mortgage and can affect whether we get a credit card or not. In this video, we will go in depth on what the credit score is and how it works. Before we begin, please like this video and hit the subscribe button with notifications turned on so you will be first to know about new content. Our mission at the Personal Finance and AMP Investing channel is to empower people to achieve financial independence. Subscribing will help us achieve that goal. Now, let's get back to today's video. Let's start by defining what a credit score is. A credit score is a number between 300 and 850 that is a generally accepted rating for a consumer's creditworthiness, or their ability to pay back loans that they have. The higher the score, the better a borrower looks to potential lenders. The credit score is based on a person's credit history, which is a lifetime measure of a number of factors including the number of open credit accounts, debt levels, repayment history, and others. Lenders typically use this score to evaluate the probability that an individual will repay the loans in a timely fashion. It is used for both qualifying and disqualifying lenders from receiving loans as well as assigning an interest rate for the loan. In general, the lower the credit score, the less likely the individual will qualify for a loan or the interest rate will be higher. The higher the score, the more likely the individual is to qualify and the lower the interest rate. The credit score was created by the Fair Issac Co, now known more commonly as FICO. The credit score is often referred to as the FICO score. FICO is a data analytics company founded in the US in 1956. The FICO score has become the de facto standard for creditworthiness in the US. There are several credit bureaus in the United States that receive information about these factors on individuals, analyze their creditworthiness, and send out information about consumers to the credit markets. The main three in the US are Equifax, Experian, and TransUnion. Scores of 640 and below are generally considered low or subprime. Lenders tend to charge higher interest on subprime mortgages than regular mortgages because they assess that the risk is higher for the lower score. They might also require shorter payment terms or insist on a cosigner who takes full responsibility for paying back a loan in case the primary borrower cannot. Oftentimes cosigners are family members. On the other hand, scores greater than 700 are considered good and may result in lower interest rates. Each credit agency has their own specific ranges for their loans, but in general the ranges are as follows. Poor 300 to 579. Fair 580 to 669. Good 670 to 739. Very good 749 to 799. Excellent 800 to 850. How the score is calculated. There are 5 main factors in determining a person's credit score. Payment history, 35% of the credit score. This shows whether a person pays their obligations on time. Thus, missed or late payments will reduce the payment history component of the score. Total debt owed, 30% of the credit score. This takes into consideration the percent of credit available to a person that is used, which is also known as credit utilization. If a borrower's credit utilization is too high, that negatively impacts the total debt owed portion of their score. For example, if a borrower only has one form of debt and it is a credit card with a $10,000 limit and the borrower constantly has used up almost all of the $10,000 that is available to him, the utilization will be high and that will impact the score. Lowering utilization will help this portion of the score. Pro tip: closing a credit card account will remove that available credit from the calculation, which will likely make the credit utilization increase. Thus, consider keeping credit card accounts open so long as you don't overuse them. Length of credit history counts for 15%. The longer there is history for a person, the less risky they are viewed. Since there is more data on a person who has had credit for a longer period of time, there is less risk for them as a borrower. Types of credit accounts for 10% and shows if a person has lots of different types of credit, such as credit cards, car loans, mortgages, student loans, etc. New credit accounts for 10% and factors in how many new accounts a person has and has applied for recently. If there are a lot of credit inquiries and new accounts opened recently, this will reduce the credit score. How to improve your credit score. Factors are constantly flowing to the credit reporting agencies, causing them to adjust credit scores based on the new data. There are several ways that borrowers can improve their credit score. Pay bills on time. 6 months of on-time payments are required to see a noticeable difference in your score. Increase your credit line without increasing your utilization rate. If you have credit card accounts, contact the lender about increasing your credit. Increasing the limit without increasing the utilization will lower the score. Don't close credit card accounts. Closing credit card accounts will remove the available credit from the utilization calculation, so this step, although more healthy financially by reducing the risk of spending on credit cards, actually reduces your credit limit. Work with the good credit repair company. If you have a lot of late and missed payments, credit repair companies will negotiate with your creditors and the credit agencies on your behalf in exchange for a fee. Given that having a good credit score can open up a lot of opportunities, it may be worth it to pay these fees. Use a credit monitoring service such as IdentiForce, Credit Sesame, Complete ID, ID Watchdog, or Privacy Guard. These companies provide a variety of services to monitor your credit and keep you safe from fraud, such as people fraudulently opening up a credit card under your name. Identity theft is an increasingly common crime and can severely damage a person's financial situation. Dave Ramsey dismisses credit scores given that his teachings are all about getting out of debt completely. He even refers to credit scores as an "I love debt" score. So what is the personal finance and investing team's view on credit scores? To be honest, it is a little mixed. In general, we believe that it is important to maintain the principles that keep credit scores high and healthy. These are related to following through on your commitments to pay borrowers back for loans. Furthermore, having a high credit score can open up possibilities that would otherwise not be available. For example, it can reduce the interest rate on a mortgage, which could mean the difference between buying a house and not buying a house. It can also be the difference in interest rates on a business loan, which could affect whether you can take a loan to start or grow a business. Thus, in general, high scores open up possibilities that can be important. On the other hand, higher credit scores can also make it easier for people to take on bad debt. It can encourage people to get a more expensive car loan for a brand new vehicle. We would suggest that instead you buy used and pay for it in cash. It can make it easier for people to get credit cards and spend more than they need and get deep in debt, which can have a catastrophic impact on a person's financial situation. So we believe in the importance of having good credit, but also caution that it is critical for people to be super careful about not taking on debt they don't need. Be disciplined to only take on the debt that is absolutely needed. Avoid taking on revolving debt like credit cards that can get you deep in debt and ruinous for your financial situation. Be careful about the allure of easy credit. Let us know what you think in the comments section below. Also, let us know if you have specific topics or questions you want us to address in future videos. Don't forget to like this video and subscribe to our channel so we can help achieve our mission of empowering people to achieve financial independence. Thank you for watching, and we'll see you next time.